Welcome to the InterMarket Analysis video update. This is a weekly video where I go through a number of different things, but the main focus is to look at other markets outside of the stock market to see if we can get any insight as to what's happening within the stock market itself. We look at stocks versus bonds, stocks and commodities. We look at other indexes within the stock market, because we can get a bigger picture look at how these markets interact with each other. This is being prepared for Monday, July 15th. Before I get started on that, I do have a thing called the SPXInvesting Program. It launched at the beginning of June. It's still free. It's still wide open. There is a link to get to the website in the description below this video, as well as some other videos to watch that talk about the program. Also, if you want to have any kind of back and forth with me, whether it's about the program or maybe you have some feedback about this video and you don't necessarily want to leave a comment, are there other areas of the market that maybe I should be covering? Are there other relationships? I try to be comprehensive here, but you never know. I might be missing something that you find actually helpful. I do put out a number of different videos each day and each week. The main focus of the video that I do and the analysis that I do is the daily video. The other videos, the weekly video, this video itself, and some additional ones, those are considered to be supplemental. They all feed into the daily video. Over decades of doing this, I've found that it's just day by day analysis. Maybe we don't see a lot of changes from one day to the next, but we can see things develop. We can see shifts. We can see changes. And I know people are busy. That's why I try to do these videos where I do the research and then present it to you in these different videos. And this is something that I've done for a long time and really enjoy doing as an educator. The first area that we look at is S&P 500 valuation. Now we look at the S&P and what is it valued, looking at a historical perspective, earnings that have already come out, and we're just getting ready to go into earnings season now as the second quarter of 2024 ends and we move into the third quarter. And then we look at what is the market anticipating looking forward from this point as far as valuation. This chart just looks historically, and we go back a number of years and we compare price to earnings, and that's called the PE ratio. And when we get really expensive, we have a PE ratio of 20 or above. When we're right around that 15 level, that's a PE ratio that's considered to be fairly valued. And when we get down to around 10 or below, the market is considered to be inexpensive or cheap. And we've been expensive now for quite some time, for many years, and this can go on for a long period of time. And so from a timing mechanism, we don't use this. We don't even use the forward-looking PE ratio because the market can stay extended one way or the other, usually expensive, because the stock market is optimistic. It's looking out into the future, and it's thinking good things are going to happen into the future. And so for the market to be expensive for a long time is not necessarily a surprise. And we're coming in well above this red dashed line with the PE ratio of 20. So on a historical basis, we are looking expensive, but we have been now for many years. This also looks at the different valuations and then events that have occurred going back to 1980. This is put out by Real Investment Advice. I actually showed this same chart a week ago, but these things don't change all that fast. This is just showing also what I just kind of showed in this previous chart, and it's confirmed by this chart where we are well above historical valuations. Now, there was another method that was developed a number of years ago by Robert Shiller called the Shiller PE ratio, or CAPE, C-A-P-E, where instead of taking just the numbers from quarter to quarter and year to year, he uses a smoothed approach. You also may hear this referred to as PE10, and then to try to deal with outliers, weird situations that occur, we're looking for more of an average basis. And he has developed this other ratio that can also be helpful. It also looks back historically, where we're coming in right now at 36.21. Well, we have a historical chart to give some perspective there. We also look at what have the numbers been historically, and we're anywhere from about 16 or so with the median and about 17 with the mean. We're at 36 right now, but we've been this way now for quite some time. We're almost double expensive when you look at the average numbers over a period of time. The market, though, looks forward and it's projecting out. What are the forecasts and what are analysts coming up with as far as what earnings are going to be going into the future? And that creates another PE ratio, and that's really what the market uses. And on this chart that is put out by Edward Yardeni at yardeni.com, we have a number of different indexes that we measure here. This purple line is the mega cap 8, the stocks that have really been driving the market higher these days. Well, they come in with a really high ratio of 31.5. That's just really astronomical. But for right now, investors don't mind that. They don't mind that these stocks are even expensive on when you look out into the future. They think it's even going to get better from here. And so they're willing to buy at today's prices with the idea that the prices are going to go up into the future. But then we look at the S&P 500, and it's also above that 20 level. So we're also getting expensive looking forward at 21.4. Looking a little bit more towards fairly priced are the mid caps and the small caps. The mid caps are coming in at 15.5. The small caps are at 14.5. Now, we might be starting to see a bit of a shift, and you'll see this as I go through some of the charts here and in some of the other videos that I put out. The small caps have been really disappointing in 2024, and they've been in a range, and we're just at the high end of that range. You could even say that maybe we're breaking out of that range. But it looked like we were breaking out before earlier in 2024, only to have things fall back down. The mid caps were stronger earlier in 2024, and for a number of weeks there, that was the strongest index. They've since fallen back, but now they're showing a little bit more of an improvement these days. Are they starting to break out too? That could suggest a rotation going from the mega cap stocks, which could still hold up. And even though we saw some weakness in the NASDAQ 100 this past week, we didn't see money coming out of the market. We just saw money going from one place in the market to another place in the market, and that is usually positive. So we want to keep an eye on these different areas, and even on this basis, though, we're still looking expensive when you look at the S&P 500 itself. Then I do an extensive analysis here of growth versus value. Growth is when you want to buy low and sell high. These are stocks that grow in value. That's why they're called growth stocks, and they're companies that grow. They typically, in this day and age, tend to be more technological or AI or really cutting edge as far as new things that are happening. And it's the stocks that usually people are talking about. And this, when you look at it by itself, this is a pure growth index. It is in an uptrend. And we look at value. Now, this tends to be a more defensive area of the market. When folks are concerned, like a hedge fund or mutual funds or individual investors, and they think, uh-oh, we're going to run into some problems here with the market. But if you operate under a prospectus, or if you're a mutual fund or some kind of a mandate, if you're a hedge fund, or if you're an investor that likes to be invested all the time, you may switch from growth stocks over to value stocks. Sometimes they hold up better. Sometimes they actually do well when the market declines. Other times they go down, but they go down less than growth stocks. Well, when we look at growth on the previous chart and then here with value, we also see that value is in an uptrend, but it's not really breaking out. If we show the previous chart, this is more in a solid uptrend where we've been chopping more or less sideways when we look at the value index. Where this can get very helpful is when we do ratios between the two. We do a growth to value ratio on top, and it did come down because we're seeing a little bit of resurgence in value, at least in Friday's session. But growth has been outperforming value, and that's what you see in a more positive environment. And then I do an inverse of that same chart because you can see there's a little bit of an offset when these moving averages cross here, because we might see something a little bit in a different way and get some more perspective by looking at things that way. Where on the bottom, this is a value to growth ratio. Then we look at some ETFs, a growth ETF and a value ETF. and do a ratio between the two. And this is a longer term chart going back to 2004, showing how growth is outperforming. Here's an inverse of that same chart, just in case we see something that we may have missed in the previous chart, showing how value is underperforming growth. And then we have these peer growth indexes again, but a longer look at this, showing how growth is outperforming. And then this is another index that we look at, showing how value is underperforming growth. So we're seeing confirmation this way. Then we look at another index study here, a little shorter term time horizon, showing how growth is outperforming value. A couple of ETFs that we look at, showing that growth is outperforming value, even though it did pull back in Friday's session. This is value versus growth, just an inverse of what we looked at, where value has spiked up a little bit, but when you take the bigger picture, it's still underperforming. Then we break it down according to the small caps. We're not seeing a lot of strength here. The small caps are showing a little bit of an improvement, and I have the index up here on top. Where are we starting to finally break out above this range that we've been in 2024? We still need to see more follow through to really be able to determine that. But when we look at the growth to value ratio for the small caps down here, not really showing any strength at this time. The mid caps also have been stronger at other parts in 2024. Are they starting to break out? They have not surpassed these previous highs yet. And the growth to value ratio is not showing a lot of improvement to this point. This is the one that we focus on for the S&P, where the growth to value ratio here has been really improving. Even though it's been pulling back a few times over the past week, this is still looking pretty solid, but we want to see more follow through with this. We keep an eye on inflation. On the top is a monthly chart of the CRB index, and that's commodities. And this has pretty much been chopping sideways over the last number of months from 2023 into 2024. Then we do a ratio, the areas in the CRB index that are inflationary. And when this is going up, that means inflation is actually outperforming. When this is going down, that means deflation is outperforming or inflation is underperforming. And we're coming back up to the moving average, but we're still declining overall. And so according to this chart, inflation is not necessarily a problem, or at least it's not growing at the present time in the bigger picture with these monthly charts. Then we have a daily chart of the CRB index where it's been chopping sideways over the last number of months, but it's still in an uptrend. And here's a breakdown of what's inside of the CRB index. And we look at the Baltic Dry Index, something else that we look at from an inflation perspective. When this is going up, that means it typically costs more to ship products, specifically in the Baltics. And this is still in an uptrend, but it's really been chopping more or less sideways as it forms kind of a triangle pattern lately. Then we look at other markets. Now, I'm not involved in these other markets, but we still want to keep an eye on them. Here is aluminum, which is in an uptrend right now. Corn, which is in a downtrend right now, and wheat, where it really bounced up, but it's now starting to fall back down. So wheat is still in a downtrend. Here's fertilizer, which had been declining over the last few weeks. Oil, which came down into the 70s, now it's going back up into the 80s. So we're seeing a bit of an increase there. Gas, which is in an uptrend, but has been pulling back. If we continue to fall or go sideways, we might see a death cross, meaning that this will change from an uptrend to a downtrend. Keeping an eye on diesel, this is the spot price. This means the price right now. This is not future. This is the current price, where we did see a little bit of a tick up recently here. Heating oil, which is in a downtrend. Of course, we're in the summer now, but still heating oil can perform in uptrends or downtrends regardless of the actual season. Natural gas, which continues to be in a downtrend, it was starting to come back up, but is now pulling back down. Copper, and we use this as a barometer of the economy. Copper is called Dr. Copper, and if the economy looks to be improving, copper will typically be going up. If copper is going down, that means the market is thinking anyway that there will be economic weakness, where we're still in an uptrend. And copper was just shooting up and went back and actually did a bit of a breakout here, but since then has fallen back. It's still in an uptrend, but it's not showing the strength that it had been showing. We look at a copper to gold ratio here, and we broke out a little bit as copper was starting to outperform gold. Then it started to fall back, and right now copper is still in an uptrend compared to gold with this ratio, but the ratio has also been falling back. Here's a longer term look at that same chart going all the way back to 1980. That's the black line, is the copper to gold ratio. To give it a little bit more perspective, here's the 10-year yield in red and the 2-year yield in green, where interest rates have been coming down, but we haven't seen a real change, at least yet, with this longer term chart with the copper to gold ratio. Here's gold, which everybody's talking about it. And there are people that they base their whole lives around gold, and that's all they promote. And, I mean, gold is actually a physical commodity that's always had value since there have been people. And so, yeah, there's something to be said for that. But we really are going sideways right now, even though when we look at the GLD ETF, this is not the futures contract, this is the gold ETF. It's really been chopping sideways and has yet to really break out of this range. Silver is also in an uptrend, not coming back and surpassing these previous high prices that we've seen recently. Then we look at the closing price for gold on top and the closing price for silver on the bottom. And you would think, well, silver and gold, just like Rudolph the Red-Nosed Reindeer, the song and everything. You think, well, they have a tendency to move in tandem with each other. And that usually is true. What we do to verify that graphically is we have a gold to silver correlation. And when we're getting a high reading like we are now, that means they are in a correlated relationship with each other. And we look at a gold to silver ratio on top. And then what's kind of interesting is in the middle area, this is the US dollar index, and they're having a pretty strong tendency to go in the same direction. So if this gold to silver ratio is going up, the dollar is probably going up. And the inverse of that is also true. Here is the dollar by itself, where it did see some weakness this past week, but it's still in an uptrend where we have the blue line above this orange moving average. This is a longer term chart where we broke out with this upwards or downward sloping trend line here, but we're starting to fall back with the dollar right now. Then we look at the dollar in relation to other currencies. Here's the euro on top. And even though this is the US dollar index, which has a lot of currencies in there, the euro is the biggest currency. And this is almost a mirror image. Like this could be the mountains on top, and this is the reflection you see in a lake on the bottom. And we can keep an eye on the Japanese yen as well, which has really been going down, and the euro, which has been chopping sideways. And then on the bottom is the US dollar index. And then we break that out. Here's the euro to the dollar, where we're just starting to see an upward move here as the euro is starting to outperform the US dollar. We had seen a death cross and it was in a downtrend. Now it's starting to go back into an uptrend. The Japanese yen, and there's reports out that the Japanese government is coming in and buying Japanese yen like crazy to try to prop the yen back up because they're afraid that it's falling too quickly against the US dollar, but it's still in a downtrend nonetheless. Back here in May, we saw another blip up as well. Any one of these blips you could possibly attribute to the Japanese government intervening, but it doesn't seem to last very long, and it doesn't seem to really change anything, at least to this point. Here's the British pound compared to the US dollar, which the British pound is in an uptrend and outperforming. And then we look at the equal weight versus the S&P 500 weighted index. And this had been underperforming, but it's showing an awful lot of improvement now as we're seeing more broad market in Thursday and Friday session. We saw a lot of improvement in those areas. Even though the S&P was down on Thursday, we saw some really positive things developing in Thursday's session that also carried over into Friday's session. And here's a ratio showing how the equal weight has been underperforming, but it's starting to go back up when compared to the S&P 500 weighted index. Here's stocks compared with commodities, showing how stocks are outperforming. And here's an inverse showing how commodities are underperforming stocks. The NASDAQ 100 and the S&P 500, they're both coming off of setting all-time highs this past week. And the NASDAQ 100 is continuing to outperform the S&P 500, but we are seeing a pullback. The NASDAQ was actually down this past week, where some of the other areas ended up being positive on the week. But for the most part, the NASDAQ 100 is still outperforming. And we look at the S&P 100, which are the biggest stocks that make up the S&P 500, pulling back recently as some of the large caps are taking a bit of a breather. At least that's how it looks for right now. but the S&P 100 continues to outperform the rest of the S&P 500. The NASDAQ, which is also doing quite well, it's also outperforming the S&P 500, even though both are doing quite well independently of each other. The NASDAQ 100 is actually underperforming the NASDAQ. And this could be positive in the sense that we're seeing more broad participation from the NASDAQ, and it's not necessarily just the NASDAQ 100 that is leading things higher when we do this ratio. So this could just mean we're seeing a bit of a shift over to more broad market stocks that, again, it's not necessarily producing selling. It's just showing us that there's a shift that's going on. And we look at the mega caps. These are the really big stocks. And compared to the equal weight S&P 500, it shows that the mega caps are really outperforming, but did pull back over the last part of the week that we just finished. Then we look at a ratio between small caps and the S&P. That's the red line here. And small caps have just really been underperforming. They're starting to bounce back up. They are showing an improvement, but we've seen improvements before only to have our hopes dashed if you focus on small caps. We want to see this turn and continue to go up and actually establish an uptrend. And then the blue area of this chart is the S&P 500 index itself. When we look at a ratio between small caps and the S&P, underperforming here, but bouncing back up. It's going to take some time to see if this is a shift that will actually last instead of just some kind of a short-term phenomenon that's taking place. The 30 biggest software companies still in an uptrend here, but not really participating in the upward moves that we've been seeing. It's been other areas of tech that have been leading things higher. Here's the mega caps, and this is the darling area of the market. This is the ETF itself, really in a solid uptrend. Did see a little bit of a pullback over the last few trading sessions. Here's the robotics and AI ETF, looking in it like it's in an uptrend here above this rainbow, but has not been able to come back to previous highs, and showing a little bit of an improvement here. It's been really underperforming when we look at AI and compare it to the tech sector. It's been really underperforming the tech sector. Well, it's starting to bounce back up now. We'll see if this can continue and actually see a shift over to starting to outperform the tech sector. The Dow Jones Composite, which takes the Dow, the transports, and the utilities and puts them together, is in an uptrend. Then we look at the S&P and compare it with short-term bonds based on price. Stocks continue to outperform. Then we look at the S&P 1500 and also look at shorter-term stocks. So even when we look at the broad market of stocks, they are still outperforming shorter-term bonds. We look at another broad market index and compare it with 3 to 7 year bonds, showing how stocks are outperforming. Here's the total U.S. stock ETF, which is 2,651 stocks the last time I checked. And this is coming off of just setting recent all-time highs. So the broad market is still looking quite positive. Then we look at low volatility stocks, and this is another more defensive area that folks get into when they're concerned about the market declining. When we look at this all by itself, it's in an uptrend, and it's above its 50-day moving average and looking pretty good. But when we compare it to the S&P 500 on a ratio basis, the low volatility ETF continues to really underperform. Then we look at the tech sector, compare it with bonds, showing that the tech sector is outperforming. And then we look at the advanced decline line studies, seeing some improvement here. This has been an area of concern, and we saw some improvement in Thursday and Friday's session with the NYSE common stock going back above its moving average. The S&P, which had been on its moving average, also coming up, seeing some improvement with the mid caps and the small caps. And this just shows more broad participation and broad improvement with the advances versus the declines. Then this is traditional Dow theory, where we have the Dow. It hasn't set a new all-time high yet, but it's getting close. It's been doing fairly well lately. The transports have been really underperforming, even though they bounced up in Thursday and Friday's session. The utilities were coming on really strong, and then we're pulling back, and now they seem to be showing a little bit more strength again recently as well. The transports, though, this would be another area that would be more positive if we could see more upward move from this index. We're just chopping around in 2024. We're in a higher range. Now we've dropped down to a lower range. If this could continue to go up and surpass some of these previous highs, that would really help the market, but it just hasn't done that yet. And we do a ratio between the transports and the S&P. It bounced up on Friday, but overall, the transports have really been underperforming the S&P. We do another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And in a more solid environment, we want to see the transports doing better, and they're just not doing that. And we look at the relationship between the S&P on top and the transports, and they're not having a real strong correlated relationship right now. So it's like the transports are not really impacting the S&P all that much. If it gets back up into this red area, then they're having more of a tendency to go in the same direction at the same time, whether that's up or down. And then instead of using traditional Dow theory, why not change it? And instead of using the Dow, why don't we use the S&P? Maybe that's a better representation of the US stock market coming off of recent all-time highs here. And then instead of using the transports, we're more of a technologically based society now. So why don't we use the NASDAQ instead? And that's coming off of setting recent all-time highs. So we're seeing some confirmation here. We can break that down even further. Instead of using the S&P, which is a weighted index, why not use the equal weight S&P? Even though this is improving, we have not gone back and set a new all-time high with the equal weight S&P, at least yet. Then instead of using the NASDAQ, why not use an equal weight QQQ, which is the NASDAQ 100, where it is setting new all-time highs here. So there's a bit of a negative divergence here, but it is showing some improvement where the Qs, the equal weight, it was setting all-time highs where we were still going sideways with the S&P equal weight. But this spike up that we saw on Friday is showing that things are getting a little bit better here. And if we can set a new all-time high with this index, that would be a confirmation. The FANG index did set an all-time high this past week, but then we saw some pullback after that. And I'm keeping this chart, just I look at it in case we really start to fall. I'll be trying to find areas of support. The Wilshire coming off of setting recent all-time highs. That's another broad market index. ARC, which really has just been a disappointment. It's in a downtrend. The blue line is crossed below the red line. It did tick up a little bit. It was up 2.38% on Friday. But after the nice run up in 2020 into 2021, it's really been a disappointment to a lot of folks that get into this ETF. And then the all world ETF, and you take out US stocks, even on a global basis, stocks are looking pretty positive. But then we do a ratio between the SPY, which is the US, and then we do that same ETF that we just looked at based on the all world stocks. This is showing how US stocks continue to outperform the rest of the world. This is a monthly chart where we do a similar type of strategy, but this is bigger picture where we do a ratio between the US stocks and then stocks in Europe, Australia, Asia, and the Far East. This is just showing how US stocks continue to outperform. And then on the bottom, we have a momentum oscillator here, which is also going up. And this is a monthly chart, so this is much longer term. We look at the price of bonds by looking at the total bond ETF, where bonds based on price are still in an uptrend. And the Pring World Bond Index, though, this continues to be in a downtrend. Now we're coming back up and showing some improvement, but not enough yet to change the trend from being negative to positive. Monthly chart showing the stock to bond ratio continues to show how stocks are outperforming bonds. This is a daily chart showing how bonds are underperforming stocks. So if you look at all the videos that I post, this is a daily chart. And then we also have a weekly chart and then a monthly chart that I just showed. On all different time frames, stocks still continue to outperform bonds. These are junk bonds here, which are coming back and setting recent all-time highs. These are more conservative bonds where they're also in an uptrend, but have quite a ways to go to get back to their all-time highs. And then we do a ratio between the riskier bonds or junk bonds and more conservative bonds. And we're seeing an interesting thing develop here. But we have seen this before, so we want to watch for follow-through. Folks are getting into the junk bonds. They're willing to assume that additional risk in order to get a higher yield. Well, if we are going to start seeing the Fed cutting interest rates in September, which is the market's anticipating that at this point, then we would expect to see this ratio going down as folks are getting out of riskier bonds and getting into more conservative bonds, locking in higher yields, thinking that those yields have topped out. But we've seen that before along the way. So we just want to watch this as it unfolds. And stock to bond correlation shows that the price of stocks and the price of bonds are tending to go in the same direction at the same time. So if bond prices are going up, that means that interest rates are going down. Lowering interest rates typically will help stock prices. Here's the Dow Jones Corporate Bond Index, which has pretty much been going sideways, but starting to break out and showing some improvement here and still in an uptrend. Then I have the 10-year yield with some Fibonacci studies, but we're really far away from these different lines currently. This is a 40-year chart of the 10-year Treasury yield where we had been seeing a gradual decline to lower interest rates. Now we're starting to get back into a higher interest rate environment. And here's the 30-year yield with some Fib retracement lines, but we're not near any of these lines currently. Then we do a ratio between stocks, the S&P 500 and the 10-year yield, showing how the S&P is outperforming. And then we look at kind of an inverse here, where 3 to 7-year bonds are underperforming the S&P 500. And for this ratio to continue declining would be more positive for stocks. Junk bonds here, which are holding up and just setting recent all-time highs. And then we do a ratio between junk bonds and more conservative bonds. Came back down to this 50-period moving average, but starting to bounce back up. If we are seeing a shift from more risky bonds to more conservative bonds, we would end up seeing this ratio continue to go down, and we're not quite seeing that yet. Here's the price of the 7 to 10-year Treasury bond ETF, which really spiked up and was able to hold on to those gains on Friday. Here's a daily chart showing the gradual decline in interest rates since about the beginning of May. Then here's a weekly chart looking internationally where we have US and UK rates. Those are the highest, and they're coming down slightly. German rates, which had been going up, seem to be plateauing for the time being. And the red line, that's Japanese rates. They are also continuing to go up, but have settled down a little bit recently. Then we have the MOVE index on top, which measures the volatility of bonds, and the VIX in the middle area, which measures the volatility of stocks. And on a volatility basis, not a price basis, but on a volatility basis, they're going in opposite directions. We're seeing a drop off in the volatility of bonds, and the volatility for stocks has already been low, but it hasn't really been moving. And that's why we're seeing this correlation showing that the volatility tends to be going in the opposite direction. Then we have a monthly chart of the long-term bond on top, which has been in a downtrend. But for the first time in quite a while, it's starting to go above the moving average. That would be beneficial if we could continue to go up here. But when we look at the bottom with the price of bonds and compare it with commodities, bonds are still outperforming going all the way back to 2023. Then we look at different sectors, and I have two different charts that I show here. This is just the sector chart itself, and I just list this based on the alphabetical symbol here. So we show materials first, and starting to break out above its 50-day moving average in an uptrend when we look at it alone. Seeing some improvement here with the green line, which is momentum. We're still negative, but starting to turn up when we look at the relative strength compared to the SPY. Then we do a ratio, the materials sector to the S&P. It is bouncing back up, but still has been underperforming. And communication, this has been a stronger area in the market, but we're seeing a little bit of weakness when it comes to momentum and the relative strength here, even though it's still in a pretty solid uptrend. And then we've been chopping more or less sideways when we do a ratio between communication and the S&P 500 and saw some weakness late last week. Here's energy, which cannot get above its 50-day moving average when we look at the sector. It came down to the 200-day moving average and bounced up off of that, but we've not been able to get above the blue line, which is the 50-day moving average. Seeing a little bit of weakness with the green line, which is momentum, as well as relative strength to the S&P 500. And then it's underperforming when we do a ratio between the energy sector and the S&P. Financials. There was a bit of a run up. Now, a lot of areas in the financial sector are doing well. It's the banks that were reporting, and we saw a bit of a run up going into Friday's session as some of the big banks are starting to report their earnings. And it was kind of a buy the rumor, sell the news type of thing, where the price of banks were going up, and then the reports came out and they didn't like the forward guidance, and so the stocks ended up declining. But we're still looking pretty solid here when we look at all of the financial sector. But it's underperforming when we compare it to the S&P, and we've seen a recent death cross here with this ratio. Industrials, which are showing a little bit of an improvement with momentum and negative, but looking a little better with the relative strength, coming back and able to get above its 50-day moving average, but on a ratio basis continues to really underperform the S&P. The tech sector, this has been one of the stronger areas, even though it pulled back a bit on Thursday and Friday, but still in a really solid uptrend. Looking pretty solid here with the momentum coming right back up and showing a little bit of an improvement, and the relative strength is still looking strong. And when we do a ratio between tech and the S&P, not really breaking out at this point, but still in an uptrend, showing that the tech sector is outperforming the S&P. Staples sector. This is defensive. Again, as I always say, think of toilet paper and toothpaste. When you look at this all by itself, it's in a pretty solid, sustained uptrend here, seeing a little bit of weakness with the momentum and relative strength. But when we compare it to the S&P, it has really been underperforming. And we look at real estate, which is benefiting from the potential of lower interest rates. And so we're seeing a little bit of improvement with the momentum and relative strength. And the chart is actually showing a little bit of a breakout here, but it's still underperforming when compared to the S&P. We want to see this continue to go up. It's in a solid downtrend currently. Utilities, which had been really strong, we're pulling back, and now we're starting to show some strength again. The green line, which is the momentum, is showing an improvement, and we're negative but turning up with the relative strength to the S&P. And utilities continue to underperform here. They had been doing quite well and then started to pull back enough to generate a golden cross with this ratio. But since that time, price has been underneath both of these moving averages. And then we do an S&P to utilities ratio. Typically, when this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. And we look at healthcare, another defensive area, also showing some strength right now and breaking out above these previous levels. But it still is underperforming when compared to the S&P, although it is improving. Discretionary, the things that in life that make it fun, still looking pretty good lately since about the beginning of June. And the relative strength, the red line, is showing some improvement where the momentum is trailing off slightly. But when we do a ratio, discretionary continues to underperform the S&P, although it has been improving lately. Semiconductors, a huge part of the tech sector, in a solid uptrend, but seeing some recent profit taking here, seeing a little bit of improvement with the relative strength and momentum. And then we look at another ratio, energy, and then we compare that to the tech sector. When this is going down, that means energy is underperforming the tech sector. We look at growth stocks and compare them with the price of bonds. This is showing how growth stocks continue to outperform. The tech sector against the 10-year yield, showing how the tech sector is outperforming. And then here's an inverse, showing how the 10-year yield is underperforming the tech sector. Discretionary to staples shows that discretionary is bouncing back a little bit, but it's still in a downtrend when compared to staples with this ratio. And then here's an inverse, showing how staples had been outperforming, although recently they've been pulling back when compared to discretionary. And gold to the S&P 500, not really showing that gold has been outperforming. You wouldn't know that by a lot of the gold folks who talk about gold like it's the end all to everything, but you probably would have been doing better off just sticking with stocks. And then here's a ratio between gold and the US dollar, where gold is starting to outperform the dollar again and breaking out. High leverage loans, another area that if we were worried about the market, this would not be holding up as well as it is right now. So this is looking pretty solid, and this is showing confidence in the economy for the time being. The NYSE composite is in an uptrend. That's a broad market measure. Here's all stocks, both US and international, also setting new all-time highs. Emerging markets starting to see a little bit of life here and in an uptrend after they've been chopping sideways for most of 2023 and into 2024. The Japanese Nikkei just finally surpassing the 1989 highs, off of the highs right now, but still looking pretty solid. The micro caps, really small companies, also seeing some improvement here and still are in an uptrend. And then we look at the home builders ETF, and this is showing some strength, and we're seeing some improvement in other areas of the market where home builders have been under pressure because interest rates have been going up. And if interest rates are starting to go down, that could really help this particular area of the market. Now, we're not really getting anything from this chart. What I look at is on the bottom, and we're looking for divergences between them. Those are these yellow areas. Right now, we're seeing more of a convergence with this study. Bitcoin, which is well off of its highs and starting to go back and battle its 200-day moving average. Then we look at a long-term chart internationally where China is starting to try to turn back up. We're turning back up at the emerging markets. Europe is starting to resume an uptrend here, starting to bottom out possibly in Japan. And we're still okay here in the US, but according to the KST, which is a long-term oscillator, we're not really showing any strength at this time. And we look at the intermarket analysis chart. The red, that's oil, which has been doing the best. And then the black are stocks. And then the gold is gold. Green is the dollar. And then blue are the price of bonds. And they continue to be negative going back to the beginning of 2024. Then we look at some correlations here, where we look at the S&P in black. And then the red dashed line, that's the dollar. And they're having a pretty strong tendency to go in opposite directions. So if the dollar is showing some weakness, that, at least right now anyway, can mean that the S&P is showing strength and vice versa. Also looking at the correlation between the S&P and oil, that's pretty much neutral right now. And then the S&P and the 10-year yield also going in opposite directions. And the tech sector to the 10-year yield also strong tendency to go in opposite directions. And then shorter term yields here, the S&P to the 2-year yield also going in opposite directions. Then some long-term studies. This is a monthly chart of the NYSE. We're above the red line, which is a moving average, and the longer-term momentum continues to be positive. Here's a daily chart, and as we go up with the record high percent index, that is more positive. And then we look at a monthly chart of the S&P, which is also above its moving average. So long-term, we're still looking pretty solid. We also put a momentum oscillator on this, and that continues to be positive. And then a daily chart of the S&P on top, and then a ratio between stocks and commodities on the bottom, showing how stocks are outperforming. And then another global measure here with the S&P on a monthly chart compared to a global index, showing how U.S. stocks are outperforming. Seeing a little bit of an improvement here with the KST. And again, this is that long-term oscillator that seems to take forever to shift. So, and then at the end of this, I go through a list of those things that are positive, and we have kind of a long list now. My definition of positive as it applies to this video is when the 50-period simple moving average is above the 200-period simple moving average. So we have the growth indexes and value indexes. When you look at them independently, copper is in an uptrend, the British pound and the euro to the US dollar, gold and silver. The dollar by itself is still in an uptrend, even though it's seen some recent weakness. The CRB index, the big software companies, the mega caps, the FANG index, the low volatility ETF. Again, when you look at it by itself, it's just when you compare it to the S&P, it's really underperforming. The staples sector, the Dow Jones Composite Average, bonds based on price, everything that we look at here except for the World Bond Index. The tech sector and semis, the high leverage loans, which is still looking quite strong. The Dow, the NYSE Composite, and Wilshire, those are two broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and even the micro caps. All stocks, emerging markets, and then at the bottom is Bitcoin, even though it's still battling its 200-day moving average. Then our list is pretty short with the negative side, and this is when the 50-period simple moving average is below the 200-period simple moving average. The Japanese yen, when compared to the dollar, ARK is in a downtrend, and the Pring World Bond Index is also in a downtrend. Thank you. I really hope you found this helpful. Please, if you have any feedback on this, let me know. Also, feel free to check out some of the other videos that I post. Please have a wonderful weekend, and I will talk to you in the next video.